I know early why they're coming to you all live. Today, our podcast is happening early because we wanted to get this exciting news to you. We have a lot going on, and we wanted as many people to capture what we're going to talk about as possible. First, once congratulations to Leon. Let's just say Investor IQ is making strides. The strides are information we'll put out at a later date, just to keep the identity secret of those involved. But essentially, there's some really good news about how the world is receiving Investor IQ. So if you are not in tune with what that is, please, you can either join our platform, reach out to Leon directly. He can tell you more about Investor IQ and what it does. But just know that congratulations is in order. Today, we're going to also be talking about some of the deals we have coming up and some of the opportunities we have in front of us. But we didn't just want to make this all about what IEA is doing. We want to talk to you all about our IEA's 4 pillars of investing. This does not mean these are the only 4 ways that we invest, but these are 4 primary ways we can see really minorities in America to build wealth, extreme wealth. So with that being said, I'm going to do a little bit of housekeeping, but Leon's going to tell you about another aspect that we're going to be discussing today.
So just to touch on this real quick. We primarily focus on the stock market. That is our bread and butter. That's our number one. Brent and I have been in the stock market since either late junior high or early high school. We've been in almost 30 years. So that's our love. However, we also know that you can't put all your eggs in one basket. And, we've always said from jump, our 4 pillars are stocks, cryptocurrency, real estate, and entrepreneurship. And so we're going to talk a bit about that today. But we do make the point that we don't have all of our eggs in one basket, and neither should you. Because if you had all your eggs in one basket last year, if all your money was strictly in the stock market and the market was down 20% to 30%, you're hurt right now. I mean, we all got hurt last year, but you're hurt maybe more than most because last year, I say we, Brent and I and IEA, we invested in beachfront property in Ghana. And over the late 2021 into 2022, but over the last year and a half, or say roughly a year, that property's essentially almost doubled in value. So while our stock portfolio last year did definitely take a hit, recovered some this year, but definitely took a hit last year, we were a bit cushioned because we knew, the land we purchased in Ghana had gone up essentially 100% in almost a year. And also we own and run IEA. As well as some other businesses, as Brent talked about earlier, Investor IQ, the fintech company I'm working on right now. We own, I own that as well. Brent's on the board, an advisor. So, we have a lot of things going, but we never put all of our eggs in one basket ever. We learned early on that is a tough way to invest. You'll get bitten in the end. So we're gonna go down our 4 pillars today.
Yep. And those for those of you all thinking, okay, tell us just what are the 4 pillars? The 4 pillars we focus on: stocks, real estate, entrepreneurship, and cryptocurrency. As Leon said, there are others. Some of you all are like, hey, I thought you all bought into companies, private equity, supporting startups. All those things are additionally ways we build wealth. But for IEA, we mainly focus on stocks, real estate, entrepreneurship, and cryptocurrency. So we're going to talk a little bit about that. Many of you that we learned aren't investing in the stock market beyond your retirement accounts. You have to go beyond your retirement accounts because essentially, most these days are doing what's called target date funds. Most of your retirement accounts are target date funds. And what that means is your 401ks that are managed with the Vanguards, the Fidelities, you get into it and they give you a selection. You get this big selection of what you can put into your 401k, 403b, 457 plan, KEO, TSP, whatever it might be. They all work pretty much the same except for profit sharing plans. What do you want to buy? Do you want to buy any of these mutual funds first? And then it's going to say, what about these target date funds? And most of it goes, oh, well, what's the target date fund? And those are funds that are kind of robo-invested for you. And robo-investing, again, layers to this, just means that they plug your information, pretty much just your age, into a computer, and it spits out this asset allocation model that they believe is going to be best for you. We then say, okay, we think we're going to retire in 2030, 2040, whatever your retirement date is. That date then becomes the target by which this robot assigns you an asset allocation model, meaning that's how they pick the stocks in this particular portfolio for a person, doesn't matter who they are, who's going to retire at that date and time. Now, think about this. The computer didn't ask you how much money did your parents leave you when they passed away. It didn't ask how much land do you own. It didn't ask you how little you have. They didn't ask you how many children you had. It didn't ask you your risk tolerance. It's just basically going to put you in this target date fund, and it may say fund 2040 or fund 2052. That's simply a date. Everybody who the computer says is going to retire at that date gets put in the exact same model. Does that make sense? I mean, just generally, does that make sense? Does that?
Yeah, because you can't put everybody in one basket. No, everyone's financial situation is different.
What happens if you have a parent you're taking care of and you need less risk? Mm-hmm. What happens if your parents have taken care of you and you have more risk? You're less risk averse. I mean, a lot of these things is taken into account not at all. So then 401ks and 403bs, some of you all have never revisited it. So you invest whatever, when you got the job, you signed up for something, you left it there, that was it. What happens to the general stock market as a whole? You're stuck in all these mutual funds and you never invest in any stocks. Now, Leon and I are not promoting single stock risk. That means that you invest in like one stock, half your portfolio, and then all of a sudden that one stock gets hit. It happened to me. And when the one stock got hit, you're talking about a loss in value of almost 47%. Luckily, with that scenario for me in particular, I had already made and been invested so long that 47% was like a drop in the bucket for how much I made in the stock in the total amount of time I held it, which goes back to time in the market beats timing the market. You all aren't getting any of that exposure. When you look at some, you have dividend paying stocks, real estate investment trusts, all these things are normally what you get when you go into purchasing single stocks. You can create a portfolio, and now they have ETFs that kind of helps get you kind of some of the mutual fund types of protection by having a big portfolio of assets, but you're only buying into one thing. You don't have to go figure out what all the stocks are. But you want to get into sectors. And Leon, you want to tell them, give them an idea about how one sector could be doing poorly when another sector is doing fantastic?
Yeah. So, and just kind of really to go back to what Brent was saying about revisiting your allocation for your jobs, 401ks or whatever, 403bs, whatever. Just I had a friend of mine who a portfolio I reviewed coming out of, it was 2021, 23? It was about 6-8 months ago. And we all know what happened in 20 and 21. Market went through the roof. It was up 30-40%. Like we all were, partying in the streets. Relative to our portfolios, not the whole COVID thing. But her portfolio was only up, I want to say it was only up like 10% or something over that 2-year period. And primarily it goes back to what Brent said. You got to review your stuff at your job, because she's in her mid 40s. And they had her predominantly in bond. Well, they had about a bond stock mix of about equal, which during the stock market ran up. The bonds didn't do anything, right? So her portfolio, she only got about 10% return over 2 years, when the rest of us got 50, 60, 70 over 2 years. And so this is why, like Brent said, it's important to revisit, even when you get a job, see what you're invested in, but also revisit over time, because the market changes. So we'll talk about sectors. Example is, so last year the market did terrible, right? Most of us that are watching us now, Brent, myself included, were really into tech stocks, and those got slaughtered, right? And we got out of those. If you followed, we got out of those early last year. Not all, so we still took a hit, but we didn't take a hit as much as most. But so that's the tech sector, did terrible last year. The sector that did great was energy, right? Brent and I haven't talked much about energy over the last 2 years, but something we'll be talking about more. But that's an example of why you have the sector diversification. You cannot have all your stocks in all your money in one sector like tech, because you can't get slaughtered as you did last year. But people that had their money in, at least some money in energy or all their money in energy, did awesome last year. Actually did awesome the last year and a half. So that's an example of sector diversification. You got to have that, as well as asset diversification, which is like we're talking about today. Cryptocurrency is one asset, stocks are another asset, real estate's another asset.
And you consider this account diversification. And you might be thinking, what is account diversification? You want to have your retirement account. Cool. That's over there. You want to have your 403Bs, which is a part of a retirement account. But then you also want to have an individual stock account, because I had a situation where someone came to us essentially saying they needed money for their water heater had broken and they needed money from their investment account to pay for it. When looking at their investment account structure, they only have retirement accounts. And so for some of you all who are like, oh, I do have stock diversification, but stock diversification is locked up inside your retirement accounts. What happens if you need money today and you're in your 20s, you're in your 30s? You're getting hit with individual no ordinary income tax on the funds that you pull out. Then for some accounts, not all, you're going to get hit with the IRS 10% early disbursement penalty for pulling money out of your retirement account. You're talking about a 40% hit for some of you all if you pull the money that you think, oh, I have stocks, but you don't have account diversification, and all that money is tied up in a retirement account. And now you have to pay 40% on it in a down market, possibly if it were last year, but you have to get it. So you're taking a hit from your account being down, and now you're going to get hit with 40%. On top of that, that's probably the worst time to get hit with it. But you know what? Most people are only pulling money out of their accounts when it's an emergency. Mm-hmm. So it's a fire situation. They have no other way, or they need it quickly, so they have to go through these extreme methods to get money. Money has a cost. So you want to look at how you're putting your money to work. Because if later on it's going to cost you money, then your money should also be earning you money. Please make sure you don't have just, you check the box today for pillar number 1, which is stocks, by saying I have a retirement account and it's invested in some stocks. Because if something comes up, you don't want that penalty. Mm-hmm. Then the next thing is real estate. Many of us have heard about family members. Let's talk about the Rockefellers, right? The Rockefellers, they check the box of real estate and entrepreneurship. So what are we talking about when we talk about real estate? Do you have an investment property? Because again, we know what some of you all thinking. I own my house, therefore I check the box of real estate.
That's a liability.
It's liability. You're not actually turning over a profit from it. Maybe you're building equity depending on where you are. If you're in the DMV area, definitely. If you're on the West Coast, sometimes it feels like the major coasts are kind of exempt from what happens to the real estate market, but it can happen. The market can always drop. We can always see a slow in the buyers out there when we're trying to sell. But more importantly, do you really want to pull equity out of your house for an emergency? I would guess the answer is no, because you're not going to, whatever it is, more than likely you're not going to be making money on it. You want to be investing in real estate, similar to what we did in the Ghana property. Leon's family has been investing in real estate for years. And so now if something were to occur, they're not pulling out of their primary residence. They can pull equity out of something that's making them money, something that has renters in it. The property in Ghana, no one's living in this land, raw land, and it's already appreciated 100%. So if we theoretically needed our money to liquidate that investment, real estate investment, we're going to walk away with 100% of what we put into it and 100% of that in the form of whatever we need to use those funds for if another opportunity came up. You have to diversify the type of real estate you're getting. Also, Jerome Powell, everyone knows interest rates have been going up. And so we were like, oh my gosh, the real estate market is going to stop. There's just going to be a seller's market, the buyer's market, because nobody's going to sell because the prices aren't going to yield what we want. That's not happening. A lot of right now, realtors are telling us that they're seeing multiple offers on properties again, people bidding up the price on the sales, which means the buyers are out there. If the buyers are out there, that means they're seeing value in the purchase. If they're seeing value in the purchase, it's normally because either they have access to hard money or their interest rate increase hasn't been enough to deter them. So what are you doing for investing? Like, besides your primary residence, again, people don't try to check the box because you have your primary residence. What investment properties do you have? From being an IEA, Leon and I have learned diversification is key, even outside of the stock market, which is why we're turning towards real estate. We have if for many of you all who are followers or members of IEA, you know that we're adding real estate as one of our primary pillars, not just to talk about, but we're investing in real estate. our realtor was out today looking for properties in the DMV area for us to purchase. We've participated in an auction yesterday on some houses. We are definitely getting out there building our real estate portfolio beyond our primary residence. What are you doing?
And,
So,
and just piggyback on the real estate thing. Here's a stat. Here's a reason why. So, as Brent said, interest rates have gone up. The demand for real estate has tanked. It's crashed over the last year, right? Last year, the Fed was raising rates like crazy. So, real estate, the value of the loan, the interest on the loan went through the roof. Went from, I think last year was around 3% to this year it topped over. Well, 2021 it was around 3%. By the end of 2022, rates were near 7% for a mortgage loan. Here's the crazy thing though. That doesn't really matter in the short and long term. Here's why. Since the great financial crisis in 2008, 2009, everyone remembers that. But what happened was the real estate market blew up. It almost blew up the U.S. economy. The world economy almost went to crap too. Like it was horrible. So what happened then was home builders stopped building homes anywhere near to the degree they were building before. So what does that mean? Over the last 15 years or so, this country, the United States, is now short about 5 million homes. 5 million homes the U.S. is short. So what does that mean? What that means is there's a floor to how low home prices can go. And as Brent said, I've been seeing this on the news too. Rates of this year topped out around 7%. They dropped down at around 6.5%. So remember, let's just say a year ago rates were 3%, and now they've more than doubled up to like 6.5%, more than up to 6.5%. Even with that doubling at 6.5%, when rates went from 7% back down to 6.5%, real estate agents said the market, people came flooding back in, right? But you're thinking, well, damn, if rates have gone up 100% in a year, why would people do that? Reason is those people don't own homes, right? They don't know any different. Like, yeah, I mean, it was good at 3% last year, but they still need to buy a home. They need to have, they're growing their family. They got to get an apartment. Their family's expanding, whatever. The country is short 5 million homes, 5 million, 5 million homes. Well, 5.0 homes in this country. So again, there's a floor. There's a floor on the how much homes can drop because of this huge pent up demand for homes and the shortage of homes. Just like right now, we have a shortage of workers in this country, and people's wages have been going through the roof. Same thing on prices, home prices. So while the crush that happened in 2021, that's kind of over. There is still going to be a huge demand for real estate now going into the future. So that's why I am very, very, very. I was skeptical last year. I was like, oh, the thing's going to go to hell in a handbasket. But as I've kind of learned the shortage of homes in this country, I am very bullish on real estate, even with rates where they are now, into the future.
Yeah, and to go back to a point that everyone should pay attention to, the interest rates are kind of going back to where they were in the early 2000s, which they were at that rate since like 1975 up to the early 2000s.
And real quick on that, just I said before, 2006 I bought my home. I bought my house. My rate was 6.875. Rates right now are about 6.875. And what happened then, right? The stock market was fine. Stocks went up. We had the dot-com crash in the early 2000s. Between then and 2007, 2008, the market was up like 50%. Right. So what that means is we're just normalizing back to the way things were years ago. And the stock market can do fine with higher rates. It just needs to adjust to them. Same thing with real estate. Real estate will be fine. It's just we got to get used to these high rates now.
Yep. And pillar number 3, entrepreneurship. Why entrepreneurship? Because it gives you the ability to control your salary. Right now, some people go to work, and when you go to work, your hope is that you get a raise. Very few of us are going to work hoping that they decide to pay us less, and we're going to stay. Like if anybody, please in the comments, if anybody is going to work thinking that if they pay me less, I have no problems with that. I think everybody will have a problem with that. So, when you own your company, it is very hard in the beginning, which, as a business advisor, I see it all the time. It's not the easiest thing, and money doesn't just pour from the heavens because you formed the LLC. However, if you can stand the test of time and you can stay the course, normally about year 3 to 5 is when you start getting normal income. And then normally after year 5 is you see incremental increases in what you can do in regards to increasing your revenue. Personally, I've seen people who have come into the entrepreneurship world survive the first 4 or 5 years, and in one given year increase their salaries 30%, 40%. That's not everybody. We get it. It's not everybody's situation. But it is one where even during the pandemic, those people who own companies were receiving grants. They were receiving funding from the government for various support, but it was only mainly for entrepreneurs. You're talking about like $17 trillion that went out to entrepreneurs for this time period, or I think it might have been
No, it couldn't be
7
70
trillion.
trillion. No, couldn't be that much.
70 trillion?
No. Well, the U.S. economy is
7.
U.S. economy is well,
It's,
no, I don't think it was that much because the U.S. economy is 21 trillion. We got
I think it was over 3 trillion that went out.
well, if you count all the stimulus that happened during COVID, it was roughly 2 to 3 trillion. Yeah.
So I say was 75%, maybe 50% of that was for entrepreneurs. I mean, you're talking about one individual getting maybe 4 or 5 million individuals.
Right. Yeah.
But
Yeah.
these are
The
individuals
largest chunks definitely went to entrepreneurs for sure. And
because they support the U.S. economy.
Mm-hmm.
Like entrepreneurship is the reason the U.S. economy does well, and we need more businesses to hire more people, to pay more taxes, to keep money flow going on in the country. Again, entrepreneurship is a great pillar to not only create a business for yourself, but to invest in. You know, a lot of you talk about private equity deals and things. That's where Leon and I have seen opportunities to invest in some of these more attractive companies early on. So maybe 20 years from now, 10 years from now, these companies are producing extreme dividends for us because we were early investors. We got in when valuations were very low. So that is the reason we see entrepreneurship as one of the major pillars for building wealth in the U.S.
Yeah, another thing about that is you can with a job your income is essentially capped, right? I mean, anywhere you work, you're not going to make typically $1 million generally. Entrepreneurship, you can make as much as you want, right? I mean, there's literally no sky's the limit to how much money you can make when you have your own business. Now, realistically, is there a cap? Most likely. I mean, we know, generally there's a cap, but the opportunity is there to make as much money as you can, as much money as you can, as long as you show value to your customers. Now, entrepreneurship is not for everybody. As Brent said, you can go years and years and years without making money. Sometimes not make money at all. I mean, sometimes you have to close the thing after a couple of years because it's just not working. So it's not for everybody, but it is an option. It is an option to again supercharge your income if you have a product or service that people want. It's a great way to make money, and then take that money and then in turn invest it in real estate, stock market, cryptocurrency, things like that. So, but yeah, it's another great way in this country to make money.
Yep. And so the last pillar is cryptocurrency. We've all heard the term. We've seen
to the moon.
Yeah, we've seen the excitement. We've seen the tears. We've seen depression. All the things that have come with cryptocurrency. It's still a emerging market. Regulation has not caught up to it yet. So when you look at what's happening specifically in the cryptocurrency space, it's a pillar to be watched. This isn't one where we're saying you want to build the house on top of it, but we are saying it's one that you need to pay attention to. From the very beginning, Leon and I have said it is not a currency. It's basically a a series of microtech companies. And I am so happy about that because it's shown itself to be very accurate. It was also believed in the beginning that it was going to have this inverse relationship to the stock market. As the stock market continued to crash, cryptocurrency was going to the moon and beyond, and it would never fail. That has proven to be false.
Totally
not only false, but false. Yeah, I mean, the industry has essentially been deconstructed from those who didn't know what they were doing to those who were just thieves in the market space. So why cryptocurrency then? It still has shown itself to parallel very well with the tech industry. And in that, we see it as kind of it tracks the tech industry, but it's slightly ahead of it. Meaning, when the tech sector is going in a positive direction, tech is, let's say it's at 4% increase or 3%, you might see cryptocurrency at like 5 or 6. But on the reverse, when you see the tech sector taking a bath, it might be negative 2%, and then you'll see cryptocurrency maybe negative 7 or 9. So it's following the directional trends, but it's normally ahead of it in regards to interest. Leon, did you have any thoughts on
Yeah,
that?
so I mean, I'll give you some numbers on that. So split numbers. So right now, as Brent said, yes, cryptocurrencies generally follow tech stocks, right? So if you watch the Nasdaq, how that goes typically is how crypto goes, right? But as Brent said, it kind of leads it. So here's what it means. So as of right now, as of today, the Nasdaq, which is generally how we track tech stocks, is up 15% this year. Crypto, and when I say crypto, I mean I'm quoting Bitcoin. So I'm just saying Nasdaq's up 15% right now. Bitcoin so far this year, and this is year to date. So this is just in January 1. Nasdaq's up 15%. Bitcoin is up 45%. 45% versus 15%. Now the general stock market is up 6%. Again, Bitcoin is up 45%. So this is what I mean. This is what Brent was saying. Like it leads it. Now this he said always happens in reverse, right? If you have tech down 5%, crypto will probably be down 15-20%. So it's a risky asset. It's a speculative asset, but it should be part of your portfolio because again, where can you get such high returns? Now, high risk is high reward, right? So you don't want to go all in. You don't want to mortgage your house for this, but you want to have less than in my opinion less than 5% of your portfolio should be in crypto. Because again, markets up 50%, tech stocks where crypto's up 45%. So we still invest in crypto. We have a crypto investment group inside IEA. We do not advocate, as we say, do not advocate for it to be a big position, but it should be part of everyone's portfolio because of the outsized returns.
Yeah, and for those of you all who aren't part of the IEA Crypto Bulls group, in our last meeting, which was the first Monday of the month, we highlighted one crypto in particular that the next day, the very next day, this crypto was up 45%. So for some of you all who are thinking, well, what does 45% mean? If you would have had $100,000 in this particular crypto the day we announced it, the day after the next day, 2 days later, you would have had 145,000 in your account.
In the blink of an eye.
Yeah, it's just nowhere else that can happen. And if you're not part of groups like these, I doubt you're doing that much research on your own. And that's the reason why people join Investing Education Academy. But that's not to say like every time we do an investment is up, because we were decimated last year.
Oh yeah.
In the cryptocurrency space. However, if you're also part of IEA, we said, hey, it might be a good time to consolidate those positions and move into the stable coins. And I would like to venture and say it was before the market really went horribly wrong.
Yeah, it was the same time we were saying when Jerome Powell announced he was going to start raising rates, November 2021. We told everybody, look, take a step back from tech stocks. We said the same thing about crypto in our crypto group. Like, you want to kind of move out of the more speculative, move more to the Bitcoin, the Ethereums. Again, they all got hit. I mean, everything got hit. But last year, Bitcoin was down, I think, 60%. Ethereum was down 63%. Some of these other coins were down 93, 95, 97%, and are still down that much.
Some went away.
Yeah, some went away, right? And here's nothing about and I'm speaking talking about Bitcoin and Ethereum. People were like, oh, it's crap. It went down. It's not worth anything. There are many tech stocks that were down way more than Bitcoin and Ethereum, right? So, I mean, I don't think like Roku. I didn't even know that I was looking at today. MJ, ticker symbol MJ is the ETF for cannabis. For cannabis companies, right? Cannabis companies. That was down over 90%. Actually, it is today, still down over 90%, which means the stocks inside that ETF were down huge. So I'm saying all this to say, people try to poo-poo Bitcoin and Ethereum and crypto at large and say that it's crap. It's not, it only goes down and you can't. Nah, there are a lot of stocks that have been around for years that went down way worse than Bitcoin and Ethereum and some of the cryptocurrency. So to me, this raising cycle by the Fed has shown me that, and again, I'm just talking about Bitcoin and Ethereum, really, those two cryptocurrencies have, they do value, whatever value means. I mean, to me, I don't really see them as valuable, but the world does. And what I think doesn't matter. So there is value seen there by investors. And so that's why we say crypto should be part of your portfolio, Because again, there are many tech stocks that we know about that a lot of us were in that were down 90+%, and Ethereum and Bitcoin were only down about 60% last year. So they beat the market.
So with that being said,
stocks, sorry.
Yeah, the 4 primary pillars that IEA believes in are stocks, real estate, entrepreneurship, cryptocurrency, and I would say almost in that order. Crypto is not a staple. We're not saying build the house on top of crypto, but we are saying it is a speculative investment that into the future we believe is going to have a real presence that needs to be paid attention to. Mm-hmm. So with that being said,
hold up, Brent,
we thank you all.
Sorry, there's a question that says, and you can answer this better than I. How do you buy land in Ghana, and at what cost?
Join IEA. So no, it's not. If you're looking forward to buy land in Ghana, a couple things you need to do is you have to know who you're buying land from, and is it contested land or uncontested land? Then after you know if it's contested or uncontested land, has it been taxed? And also then once you know who is taxed, you got to know the jurisdiction it's in, if it's really run by the government or is it run by a local chief. Those are some of the aspects that you need to know. But then infrastructure wise, you need to know what the infrastructure is coming around, whatever the asset is you're investing in. We'll be going back to Ghana in March, April. And so we're going to be doing, and we have some videos that we have coming out about the process for buying real estate in Ghana for those interested. But you're talking about an industry that recently it was announced that a $350 million movie studio is going to be built in Ghana from an individual from California. It's very unlikely that somebody is going to decide to put $350 million into an economy that they think is going to tank. It's been said widely that it's believed that Ghana is going to be one of the next big economic surges for investors. So we're just making sure we're part of it. So if you want to know more, I would say get in touch with Leon or myself. We have extensive knowledge on it. Like I said, we're going back in March to looking at buying a more property. I'll put it like that. I don't want to give too much away because we're still figuring it out. But also next week, we're heading out to Morocco to look at some property in Morocco. So it's definitely a journey that we're involved in, but we're doing it for our Panthers. We're doing it for our community to make sure that we're not just reading about this stuff. We are boots on the ground. We're figuring out how does this land thing work and what goes wrong? Because and for those of you all who don't know, our first deal that we did in Ghana, pretty much we lost 100% of it almost.
We lost, the total is about $2,500-$2,600 on our first attempt to buy land in Ghana. But we look at that as that was our the cost of education of the land buying process in Ghana, because it is not like buying land here. Ghana has its own culture, its own way of doing business. We learned the hard way, but we took the L. We were fine with it. Then our second deal, we got that through, and now we have beautiful beachfront property in Ghana. So and as Brent said, next week, going to Morocco to look at something there. So and all these and the deals we're talking about again are the deals that we present to the portfolio Panthers, our investment group inside of IEA, where we actually invest together.
Yeah. So it's a lot to come. We were invited out to a private jet event in Arizona last week. It was last Thursday.
Thursday, yeah.
It would have been last Thursday. And I mean, we're now getting invited to these things that we probably were never on anybody's radar for. Not because they just want us to come. We actually own part of this jet company. Mm-hmm. So it's one of the private equity deals we did probably in 2020 that's just starting to bear fruit. And it was announced that this jet company will be IPOing, and we're pre-IPO. Like we've been in since the seed raise. So this is exciting stuff, but you have to be part of groups. And again, we're not even just saying just us, but you have to be part of groups in order to be aware of
to be exposed. I mean, there are tons of, like I said, maybe not us. There are tons of groups on Facebook. There's tons of groups on the internet in general that you can join. But you got to be exposed to things, and that's really what we're doing for the IA community and the Panthers as well.
Yeah, and me and Leon, we aren't sliding across the hood of Lamborghinis or showing everybody like this is how throwing money in the air. That's not our personalities. But when you pick a group to be a part of, you need to pick one that you believe in the leadership. You understand what is the risk factors, because there risk in anything that you do. But if the leadership is transparent and they're not speaking from their golden balcony about what riches they could bring to you, that's probably who you want to be with. The ones who are not doing that. That is, the ones that are standing up there just saying you can be like me, do exactly what. Yeah. I would caution you against those, because a lot of them, the reason why they are wealthy is because people are paying them to get wealthy, not because they actually made it in the market.
Right.
So
and their wealth could also be questioned, because anybody could put on a nice show on Instagram, but is it real?
I can go rent a Ferrari right now.
Right. So, right.
So it's just when this is just talking points for those who are still listening to this podcast. When IEA becomes 10 years old, it's going to be very interesting to see the type of assets we have at that age based off of all the decisions we're making today. And I'm going to bet that once we start showing people really what we own, that's when the flood of people are going to come to join, because they're going to see the shiny objects.
Right.
But when we're buying these things and they're all rusty and we got to send them off to be polished, nobody wants to be involved.
Right. Yep. I mean, it's a shiny object syndrome. People don't, they only gravitate once they see the shiny object. But the problem with that is by then it's too late. Things have appreciated. It's already shiny. It's already polished. Now we're looking to sell it. We're not looking to, you're not going to make any money off it because it's already appreciated. So, yeah.
The IEA in general provides great knowledge and information for those who want to learn about investing. We have 3 levels that you can join from. So it's not as if you have to come into the Portfolio Panther level, but that is where we invest together. And, even in that group, we've seen an explosion of membership. So we're at like 12 members or so. And when we get to 15, it goes from $5,000 a year to $10,000 a year. And we only have 3 more slots left before we get to that level. We don't even talk about it a lot, because for us, it really doesn't matter. We just want to build with those that want to build with us. We don't want to just market and get 1,000 people in. We kind of want to deter people from joining, which is why we're increasing the price.
That price raise is for a specific reason. We want serious, qualified people that are serious about doing this, right? And you have a bunch of people in the room that aren't serious and really maybe can't access the funds and or can't even contribute anything to the group. That's what we want to stay away from. We've seen that, and so we're definitely particular about who joins the group. But yeah, I mean that's where all of our private equity deals happen.
Yep. So we know we owe you. We're running long, but basically we want to let you all know, pay attention to those 4 pillars: stocks, real estate, entrepreneurship, cryptocurrency. If the only stocks you own are inside your retirement account, contact Leon or I.
Yes.
We need to get you set up with something else as quickly as possible. If the only real estate, the box you can check is real estate that you own, right now I'm in my office and we own it. It's not rented. It's not somebody we're paying for a sublease. We own this office, so it's another piece of real estate that we own. Entrepreneurship. Leon owns his own company. I own my company. We have IEA together, and we're doing other things. It's not just one field of entrepreneurship, one lane of entrepreneurship. We're staying in cryptocurrency. We own cryptocurrency. We don't have all of our crypto on just one platform, because some platforms don't even exist anymore.
Disappear.
And we warned people, pay attention. So, my point is, just because you can check the box, don't check it in this very linear fashion saying, oh yeah, I have that too. It needs to be bigger than just one aspect of these various pillars.
Last one for me is, when you check that box, the way my test for myself is ask the question: does this cash flow? In other words, does this produce income? Does this produce money for me every month? If it does not, then in my mind, it's not an asset. Well, I take it back. It's not
it could be building equity.
Yeah, but let me take it back. Yes, does it? Yeah, there's 2 things. Does it cash flow is the first thing. I'm always looking for that income. But if it doesn't, then it needs to be an asset that can build equity over time. And if it does both, that's even better. is you have a rental property and the property value is up over time. The land we have in Ghana, that's appreciated 100% already. Once you put something on it and actually, rent it out, that's cash flow. So it's those two things, the cash flow and or appreciation value. But like Brent said, don't look at your home really as either one of those, because that's a liability, because that's taking money out of your pocket every month. So, that's the way I look at it.
All right. So we owe you all 2 stock picks, which we'll be putting into the platform. And you can go to IEAmembers.com to join, or you can go to IEAmembers.com to log in to see what those 2 stock picks are. We thank you for being with us, and we look forward to seeing you in 2 weeks.
2 weeks.